Hey, folks, quick reminders again. I don't think you need them, but I'm going to give them to you anyway. You're going to turn in your valuation feedback, try to get it in by Friday night, even Saturday morning. I want to get it out of the way this weekend, because as you well know, on Monday you have your quiz. In fact, all 3 of my classes have quizzes on Monday, which means that I know exactly what I'm going to be doing Monday night and Tuesday. And it's not going to be returning valuation. So I would like to get this out of the way before that load comes in. So, do I look like I'm wearing sunglasses? I just want to make sure. I made the mistake of picking the wrong pair of glasses up when I was in California last weekend. And this is the one that automatically turns shades. And I hate it because sometimes it doesn't know the difference between sunlight and fluorescent light, and it starts to turn dark. And I feel like a rock star who's had too much to drink, who's trying to cover up. I'm not trying to cover up a hangover or red eyes. I just picked up the wrong glasses. So in case my glasses start to turn dark, that's exactly what's happening. Okay. So today we're going to do more valuation. So again, let me start with a couple of very simple questions, but they're actually going to start a hole that's going to get much deeper. Now, today we're going to talk about valuing emerging market companies. And emerging market companies are not the only companies with bad corporate governance. It's all over the world. Facebook has bad corporate governance. Google has bad corporate governance. But let's say you're valuing a company with bad corporate governance. And let's say that the company is also badly managed. Remember, if you have bad corporate governance and you're well managed, you don't care, right? Bad corporate governance and badly managed when you care. Let's say it's badly managed. And when you do your cash flows, you bring in the fact that it's badly managed and badly run. You come up with a value of $100 million. Should I be discounting this value for bad corporate governance? Why not?
It's already in the cash.
And how do I know it's in the cash flows? Because I estimated the cash flows, right? So if you get to this point and you're not sure what you built into your cash flows, you have far bigger problems. If you've already built in the fact that this company keeps growing with a 6% return on capital, even though its cost of capital is 10%, you're effectively assuming that not only is bad management here for the next year, the next 2 years, it's here to stay. Remember when you get to the terminal value, we talked about what happens when you have a return on capital equal to the cost of capital, your growth ceases to matter, right? If your return capital is higher than the cost of capital, growth increases value. Can you have a company that in terminal value earns a return on capital less than the cost of capital? Yes, in which case you will get a terminal value that's lower than your book value. And if you could change the way the companies run, you would, but with terrible corporate governance, because it's a family controlled company or the insiders own shares, you might have nothing you can do. So we're going to talk about where, because people never believe you. They say it's already in there. So I want to give you a very simple mechanism for extracting how much of a discount you've already applied on it. You know when you might want to apply a discount though? Is you assume everything moves to industry averages. I give you that choice to hang yourself, right? Because the industry average is right there. So you move the margin to the industry average, the cost of capital comes down. Implicitly, you're telling me a story that this company is badly managed. It's going to find a way to fix itself. And if you're valuing a company where corporate governance is terrible, you might want to rethink that assumption and say, maybe not everything is going to move to the industry average because this company is just badly run and there's nothing I can do to change it. Next question. The other thing we're going to do today is we're going to value distressed companies. Now, of course, the class is on distress, but they focus on the bonds in distress, right? Let's say you're investing in the equity of a distressed company. And you learned every lesson that you need to learn about projecting cash flows. So you make realistic assumptions about the expected cash flows. You take Bed Bath and Beyond. Let's take a company on the edge of the cliff. You project out expected cash flows. You bring the revenues down because you don't think the revenues will grow. You stabilize their margins over time, but at a lower level. You attach a discount rate that reflects a high cost of debt and a high cost of equity. And you come up with the present value. You've done everything right. You've done discounted cash flow valuation the way you're trained to do it. You come up with a value for the company. What does distress mean? That there is a chance this company will not make it, right? Will the value you get from a discounted cash flow valuation for a distressed company get the value right? Maybe it's already in there like it was for corporate governance. Will it be too low or too high? Anybody want to give that a shot? And tell me why. What is it about discounted? Because we did everything, we're doing rational, right? What is it that's the discounted cash flow valuation is not capturing? The risk. So remember we talked about truncation risk? When you do a discounted cash flow valuation, whether you like it or not, you're valuing your company as a going concern. And if there's a chance that that will not happen, you have to explicitly bring it in. And you know, the pushback you're going to get is, right? Why didn't I just put it into the discount rate? It's not going to work. Discount rates are meant to capture operating risk. You can look at cost of capital for really distressed companies. They're not 1,000%, which is what they should be the day before you go bankrupt or liquidate. They'll be at 15, 16, 18, 20. They're blunt instruments. They were never designed to capture this kind of risk. So today we're going to talk about how you estimate that failure risk at distressed companies. And it's easier to do than with startups. We have the ammunition to do it. And then you have to ask a follow-up question. What exactly will my equity be worth if that happens? So both big questions, because they're questions I think we deal with badly in intrinsic valuation, but questions we'll come back to. So let's go back to where we were in the slides. I'd finished my Amazon valuation in 2000. Remind me again what I found. I valued the company at, remember? I actually valued it at 35. The market valued it at 84. I found it significantly overvalued. January 2000, peak of the dot-com boom. 1 year later, AIMR came back to me and said, would you do another webcast on dot-com companies? But the frame of reference had completely changed. Because in that intervening year, think of what had happened. The dot-com boom had bust. The economy that was never supposed to go into recession again was in a recession. Risk premiums had risen. The world had changed. So I revisited my valuation of Amazon in 2001. And I got more pessimistic. That story I told became a little smaller because I said the pathway to glory is not going to be as easy as it is. I brought in a failure risk now, which I hadn't done in 2000 because I learned my lesson from 2000. And the value that I got per share was about $20 per share. And I remember finishing the valuation and somebody in the audience said, aren't you uncomfortable that your value changed so much in a year? And my response was, after a year like last year, I'd be uncomfortable if my value didn't change at least this much. But you can see why the question comes about, right? For whatever reason, we're taught that intrinsic value can't change. You've done everything right. Why would it change? Because the world changes around you. And if you think I've changed my mind going from 35 to 20, how would you characterize what the market has done? It went from 84 down to $11. And now I was trapped. Let me explain what I mean by trapped. Remember a year ago, after I finished the valuation, what did you ask me? Are you selling short? And then I had this little song and dance about time horizon and I can't do it. And you let me escape. Now I'm trapped because now what's the question you're going to ask me? Are you buying? And now I have no escape hatch. I bought Amazon for the first time in January 2001. You're saying, what do you mean for the first time? When you invest in some, think of how many books there are on when to buy stocks. Think of how few books there are on when to sell them, because it's almost this implicit wisdom that once you buy it, just leave it in your portfolio for the rest of eternity. But that statement is inconsistent with the notion of value investing, right? Because value investing is you buy something when it's undervalued. What's the flip side of that? You hold it until it becomes overvalued. You need to sell it. Every investment in my portfolio, I have to do a maintenance valuation at least once a year. Sometimes more, because if something big happens, I've got to go back and revisit it. I did my maintenance valuation in 2002. My value actually increased significantly over the course of the year because the immediate threat of failure had gone away. My value went up. The price also went up, but the stock stayed undervalued. Basically, Amazon has earned the right to stay in my portfolio the next year. 2003, it's a great year for value. My value almost doubled, but the price tripled. I mean, this is my story, my valuation, my actions have to be consistent. And I said, it's time to leave. It's a good journey, but no. I bought Amazon 4 times in the last 20 years. I've sold Amazon 3 times in the last 20 years. That kind of gives away where I'm with Amazon right now. But essentially, this notion of never. I mean, I hear people say, I will never buy Snowflake. I will never buy. How can you say never? At the right price, you should be willing to buy anything. And right now, when you finish your valuation, you might say, I think this stock is overvalued today. I would not buy it today. But don't follow up and say, I'll never buy the stock. Because who knows what the next year will bring and where that price will be a year from now. So my Amazon valuations, I've done pretty much every year from 1997 through 2022. My most recent one that is public is the February 2022 valuation of all of the FANGAM stocks. You can take a look at how much the numbers have changed. Now, one of the things I also did in 2014 when I was updating my 2014 valuation is I did something that I usually don't do because it kind of depresses you to see how wrong you are in your forecasts. 2014, I went and looked at what the actual revenues for Amazon were. And remember in 2000, I forecast out the revenues in year 1, 2, 3 with that compounded revenue growth of 42% a year. If you take to 2010, which would have been year 10, I was projecting revenues of 41 billion. They actually came in lower, but in the years after, you can see they took off. So in 2010, if I'd stopped, I actually was much too optimistic about Amazon. What I missed was they got a second wind after it's almost like they were moving towards steady state as a large retail company. And they said, you know what, that's not what we want to be. I'll talk about the story shift in Amazon. But actually on revenue growth, if you pull it out to 2014, I'm undershooting. They're actually, if you look at year 2014, my revenue forecast was 51.5 billion because I saw them become the 6th largest retailer. Their actual revenues were 85 billion. So on that part of the story, I undershot. But take a look at my margins. Those are my projected margins for Amazon. There are the actual margins. Again, as you go towards 2010, it looks like they're moving in the right direction, right? They're maturing, the margins are improving. And then all of a sudden, they seem to be going in the other direction. You can read it in one of 2 ways. You can say, you know, Amazon is going backwards. Or you can say maybe they're changing from what I thought they were, which is an online retail firm, to something else. In 2012, when I valued Amazon, for the first time in my valuations of Amazon, I stopped in my story describing it as an online retail company. I described it as a disruption platform. Because that's what they started doing in 2010. They said, hey, what we did in retail, we can replicate in logistics. We can replicate in, in grocery retail. We can replicate in food delivery. They essentially, they were reframing their story saying, we can go after any business with soft spots because we're going to go after them. So I'll show you my valuation from, click the page. But if you go to my February 2022 valuation, you're going to see that disruption platform. Tell me the upside of becoming a disruption platform. What does it do to your story? What's your total market if you're a retail company? It's retailing. If you're a disruption platform, it could be everything. Your upside is you could have 2 trillion in revenues if you're in 10 different businesses. That's the upside. The downside is it's a lot of distraction along the way, right? And Amazon, for the most part, has balanced the two. But in the last couple of years, I think the distractions are starting to get in the way. You can blame Andy Jassy for it because he's now the CEO. But the reality is when you're in the logistics business, the retail business, the healthcare business, and you decide to add business after business, somewhere along the way, you might end up becoming less effective at these businesses. But to show you how much Amazon is viewed as a threat across businesses, about 6 years ago, I saw a survey of the CEOs of the 50 largest market cap companies in the world. They're very diverse companies. And I'm going to go through the list of companies, and you tell me whether this company thinks about Amazon. Walmart. Amazon lives in Walmart's head. I don't think there's even Walmart in Walmart's head. It's all about what would Amazon do? We've got to do it differently or do it the same. So clearly, Walmart, it dominates it. What about FedEx? You think FedEx thinks about Amazon? Hey, if you think about logistics business, clearly Amazon's footprint is almost as big or even bigger than the footprint of either FedEx or UPS or the US Postal Service now. But to show you businesses that you don't normally think of as being threatened, they asked Jamie Dimon to list out. So each of these companies, the CEO was asked to list out the 5 companies that they were most worried about in terms of competition going forward. And Jamie Dimon at JP Morgan Chase, one of the companies listed was Amazon. He said, why would JP Morgan Chase be afraid of Amazon? Does banking have a lot of soft spots? I remember when I moved from the East Coast to the West Coast. I moved from a JP Morgan Chase bank in New Jersey to a JP Morgan Chase bank. I'm moving my money, the same bank, from one branch to another branch. It should be effortless, right? They charged me a $45 fee. And I said, what exactly did you do? Take all the cash out of my account, put it on the back of somebody, make them walk across the country? It's simply absurd. It's just pure, we can do it, because what choice do you have? It pissed me off, and it's building up. I'm waiting for that email to come from Amazon Bank saying, we're thinking of starting a bank. Would you be interested? I mean, would you want service at your bank to look like the service you get on Amazon Prime? I would. You don't like that cost, go return it. There's a drop-off box. Now, one of the things that helps me on stories is to visualize the story. When I think of Amazon, you know who I see? I see Thanos from the Avengers. Yeah. Because when Amazon enters a business, here's one thing we don't know, whether they'll ever make money, but here's the other thing we know. That business is going to be less profitable from this day on. The day that Amazon bought Whole Foods, the collective market cap of grocery stores dropped by $50 billion. The day Amazon decided to enter online retailing in Chile, Chilean retailers lost 25% of their market cap. Because people know that the economics of that business have been shaken up. So I tell CEOs, if you have a moment of prayer, get down on your knees, look up to the stars, say, please God, don't let Amazon enter my business. Because nothing good can happen to you. They might lose money, but you're definitely not going to be better off after that. With Netflix, you know what comes to mind? A hamster on a wheel. That's what I see when I see Netflix. Because, I mean, think about the Netflix model. Throw 100 new shows up every day. 95 of them are unwatchable. I was in a podcast yesterday, and the person, for whatever reason, asked me what I was watching on streaming. And I said, the one thing I've stopped doing is looking for something on Netflix because I have more false starts on Netflix than on any other streaming. You know what a false start? You start a show and 10 minutes in, you say, I don't have the time in my life to waste on this. I started that show, Money Heist. If you're Spanish, you should banish the show forever because it makes everybody in Spain look stupid. You have stupid, basically every person in that show. You got to say, how stupid can be? The policemen are stupid. The hostage takers are stupid. The hostages are stupid. And after about 30 minutes, you're saying, this is killing my brain cells just watching this show. But Netflix has no way to get off this wheel, right? Because they've trained people. You open up Netflix, no new shows? What's going on? Only 10 new shows? That'd be at least 50 for me to be interested. Hamster on a wheel. So I want you to think, whatever story you're telling for a company, think about a character from a movie or a character from a cartoon and say, that's the Roadrunner is what I see whenever I see this company. If you've never seen the Roadrunner, you should see Wile E. Coyote and the Roadrunner. Maybe Wile E. Coyote is what you see. Is off a cliff, smash at the bottom over and over again. Maybe that's Credit Suisse right there, Wile E. Coyote from the Roadrunner. So with that long lead in, let's now talk about mature companies. So young growth companies, any questions in general? Some of you are valuing young growth companies. It's not easy. You're going to make lots of mistakes. You're going to say, this is incredibly difficult to do. But remember, you're not alone. Everyone valuing this company, including the people running the company, face exactly the same uncertainties you do. Let's now talk about mature companies. What makes mature companies easy to value, usually? You have a lot of history, right? They're set in their ways. Let me ask you a follow-up question. Can you get set in ways that are not good for you? Forget about companies. Do you do things every day? So I should not do that, but you're so used to doing that you keep doing it. Companies get into bad habits. So you can have mature companies that are doing things that shouldn't be doing. It's creating value destruction. And finally, somebody draws their attention to it. You shouldn't be doing it. And who's usually that person? It's usually not somebody in the company. It's somebody from outside, a Carl Icahn, a Bill Ackman. That doesn't make any sense. Why do you guys keep opening stores if nobody's coming into your stores? Now, initially, of course, the company says, no, we're going to continue to do what we do. But now you have two pathways for the company. One is the pathway, the status quo, which is to keep doing what you're doing. The other is this modified pathway. Maybe you change the way the companies run. And that's going to create problems in valuation because each pathway is going to lead to different inputs for the company. So let's take the 4 questions. What are your cash flows from existing assets? Sorry, where am I in this process? What are my cash flows from existing assets? With the status quo, you might get one number because, and with the changes where you sell off 3 businesses, you might get a different number. And ask you, what's your value from future growth? With the status quo, you get one set of answers and one value. But with somebody else running the company or a different way of running the company, you might get a lower reinvestment rate and a higher return on capital, or a higher reinvestment rate and lower return on capital, depending on what you think is a better way of doing it. How risky are you? Again, with the status quo, you might get one number because there are 8 businesses. But maybe what you're going to do is do what Alibaba does and break up into 6 different businesses, and maybe that'll give you a different risk profile and a different cost of capital. Every question, you now get 2 answers. And if you try to bring them all into one valuation, it's going to be a mess, right? Because you have 2 different ways of running the company leading to 2 different values. Do the right thing. Nothing in valuation says you have got to fit everything into one DCF. Nothing stops you from valuing the company more than once. So I'm going to give you an example. It's a company that some of you might have heard of, but even if you haven't heard of the company, you probably have heard of the most famous product. It's a company called Hormel Foods. It's an old company. It's been around a long time. And it produces a product that I think is the single most odious thing I've ever seen sold as a food product. It's called Spam. You ever heard of Spam? Spam is this slimy looking ham in a can that has a life that will last beyond a nuclear winter. For the rest of eternity. How the heck you make meat last forever? I don't know. I don't want to know. But you know how Spam was created. Does anybody know the story of how Hormel came up with Spam? After the Second World War, the US Army was trying to get its soldiers back from the Far East. And getting from Asia back to the US, none of the US aircraft could make that flight. So they had to stop in the middle. So what's between Japan and the US? What's right in the middle there? Lots of ocean, but there's Hawaii. So they land in Hawaii. And this is not the Hawaii of today with 5-star hotels. This is a Hawaii of 1945. You have tens of thousands of hungry soldiers landing. They don't want pineapple to eat. They want meat. So the US Army puts out a requisition. We want meat, and we want meat that we can use without having to store in a refrigerator. We don't have enough refrigeration space, and Hormel came up with Spam, which is one reason if you go to Hawaii now, you can actually get cookbooks with Spam. Everything you can make it Spam. Spam casserole, Kung Pao Spam. I mean, you name it, you can make it with Spam. It tastes terrible, no matter how you make it. But that's a kind of product Hormel Foods has. Lots of names that people recognize. You Hormel chili, Hormel beans, you walk down a grocery store. They've been around forever. Mature company. But a very conservatively run company. It used to be a family-controlled company, but the family, it's so old, the family's kind of moved on. And now it's run by managers. But it's run conservatively. In what sense? The company refuses to borrow money. It borrows very little. Why? Because they don't like to borrow money. They think the world ends on the US coast, that basically they don't believe the rest of the world exists. There's no global dream, so they reinvest very little. Their reinvestment rate is about, if you look at their reinvestment rate for the most recent year, the reinvestment rate is about 14%. So they reinvest very little, they grow at a low rate, they use very little debt, and they're set in their ways. So initially, here's what I did. I valued Hormel Food with their existing ways, low growth, a higher cost of capital than they should have. And I came up with a value per share of about $32. Could Hormel Foods be run more aggressively? Yes. What would that mean? I'm not going to go crazy and give them a 30% growth rate, but they could reinvest more, let's say 40% of their after-tax operating income. That reinvestment rate, a higher reinvestment rate. I'm going to be realistic. This might mean taking projects with lower returns than they used to, and I'm okay with it. It's still higher than the cost of capital. So the 2.75% growth becomes a 5.6% growth rate. So I'm not, again, making them into a high growth company, but I'm pushing for more growth. Some of that has to come from outside the US. And on the cost of capital, they use only about 10% debt and 90% equity. They could borrow a lot more. How much more? I'm going to take you through the process. And if you've been in my corporate finance class, there's a very simple process for figuring out the right mix of debt and equity. And in this case, for Hormel Foods, I think they can go up to about a 40% debt ratio, which lowers their, 20% debt ratio, which lowers their cost of capital to about 6. And I'm being conservative at 20%. They could probably push to 30 or even 40, but I don't want to put the company into distress. So I'm making small incremental changes, slightly more debt, more reinvestment, higher growth. I revalue the company, $38. We've got two values for the company, right? $32 with the status quo, $38 with changes put in. I'm an investor. I can buy only at one price. I said the stock price is 34 right now. He said, what do I do? 38 is higher than 34, 32 is lower. Well, both the status quo and the changes can't coexist. There's got to be a probability of one happening or the other happening. So I try to assess the likelihood of change coming to the company. So what might be some of the things I would look at to make a judgment on how likely it is that change will come? I looked at the top 17 shareholders, and whose name would I love to see at the top if I want change to come quickly? I'd like to see a Carl Icahn, a Bill Ackman, an activist investor, right? Not there. The largest investor in the company was an entity called the Hormel Foundation. You're saying, what's a Hormel Foundation? It's a Hormel family. Remember, they used to run the company. They've all gone on. They live leisurely lives, but the shares they own is held by the Hormel Foundation. They own 27% of the shares. So if you can get the Hormel Foundation on your side, change is going to come, right? So I took a look at who headed the Hormel Foundation. Maybe I could get an ally. You know who the head of the Hormel Foundation was? The CEO of Hormel. Now, this is going to make my life a lot more difficult to get change going. So I got realistic. I said, look, there's no 50% chance of change. It's probably going to be 10%. Why even 10%? Because Hershey used to be structured exactly the same way. And eventually they had to change because the board of directors recognized that by staying the way they were undercutting their end game. They have this, the foundation had these charitable, things that they did, and they weren't able to do the things. So I'm going to attach a 10% chance to change and a 90% chance to no change. And my expected value is 32.50. When you have change coming and it's going to be discrete and it's going to create different outcomes, bringing in, instead of trying to put it all into one valuation, create valuations under each scenario. Next week's valuation of the week, even though you might not be looking at it, take a look at it, is going to be a valuation of EasyJet that I did in 2019. EasyJet, of course, is a UK discount airline whose revenues come from flying, people to holiday destinations in Europe. You're saying, so what? 2009 was peak uncertainty about Brexit. And it had huge consequences for EasyJet because if there was a hard Brexit, there was a very real chance that the EU would say you can't even fly into the EU area because, there are certain requirements. They'd have had to move their headquarters from the UK to somewhere in Europe to continue to do what they did. So I actually valued it with 3 different scenarios: hard Brexit, soft Brexit, no Brexit. Came up with 3 very different values. And then I detached properties. You're not evading that responsibility. But when you have a company that's subject to a big regulatory change that might or might not come, rather than say which one is going to happen and try to put it all into one valuation, do 2 valuations and deal with the probabilities of each one happening later. So mature companies, for the most part, are easy to value, but that doesn't mean they're a slam dunk. So let me talk a little bit about debt ratios, because, as you can see, I used a higher debt ratio. And of course, when you talk to analysts, they always seem to believe that using more debt will always lower your cost of capital. That's a myth. It's an easy myth to disprove. In fact, if you want to think about what will happen to my cost of capital as my debt ratio changes, here's the one thing you cannot do. You cannot keep your cost of equity and your cost of debt fixed and just change the ratios. Because if you do that, you know exactly what's going to happen, right? The cost of equity is much higher than the cost of debt. If I just change the mixes at a 99.99% debt, my cost of capital is going to be lowest, which is nonsensical. The reason it doesn't make sense is as my debt ratio changes, both my cost of equity and my cost of debt will change. Intuitively, you can see why, right? If you're an equity investor in a company and I double my debt, I've made your equity earnings more risky and you should demand a higher cost of equity. And we actually created a mechanism to do that, right? So when we talked about betas, rather than take a regression beta, what did I say we should do? Take a bottom-up beta, lever it up using your debt to equity ratio. So what you see here is my beta for Hormel Foods at different debt ratios from 0 to 90% debt. And not surprisingly, as my debt ratio climbs, my beta climbs. As my beta climbs, my cost of equity goes up. Your cost of equity will always go up as your debt ratio goes up. There's no escaping it, no matter what type of company you are. Turn to the cost of debt. Usually we get a cost of debt looking at a rating, right? But that's static. It looks at the existing debt ratio and the existing rating. Consider a little experiment. Let's take the company you're valuing and let's say it doubles its debt. Do you think its rating will change? You double your debt, the ratings agency is going to freak out. They're going to revisit your rating and they're going to come up with a new rating. You're saying, how the heck am I going to estimate it? Remember how we estimated the cost of debt for companies without ratings? What's the ratio we used? interest coverage ratio, operating income divided by interest expense. So here's what I do. At every debt ratio, I compute your interest expense and compute an interest coverage ratio. Not rocket science, but as my interest coverage ratio changes, I compute a synthetic rating. And guess what? As Hormel Foods keeps borrowing money, its rating is going to slide and eventually become single C, double C, based on how high my debt ratio goes. My cost of equity changes, in fact, both go up, cost of equity and cost of debt. But here's the trade-off. Debt is cheaper than equity. So I'm replacing more expensive equity with cheaper debt, but I'm pushing up both at the same time. The net effect shows up in my cost of capital. And what you see at Hormel Foods is something you're going to see at most companies. Initially, as you borrow money, my cost of capital decreases 7, 6.8, 6.59, 6.57. And around 30%, you start to see the beast turn. Debt, the other, if you think of debt as a double-edged sword, the sharp edge is now towards you, and you can see the cost of capital start to go up. On a pure optimization basis, the cost of capital that will maximize the value of Hormel Foods is about 30% debt. You're saying, why do you stop at 20? If you're going to make a mistake, it's better to undershoot than to overshoot on leverage. So I've kind of given them a buffer here. So they can't accuse me of pushing them beyond the limit. But this is a simple way in which you can stop and ask about your company. How much can my company borrow? What is the right mix of debt and equity? Incidentally, if you go to my spreadsheet section, I have an capital structure optimization spreadsheet that we use in the corporate finance class. You're welcome to download it, put the numbers for your company. There are like 9 numbers I asked for. It does this whole table for you because it's not rocket science. It's very mechanical. And it's designed to ask the question, what's the right mix of debt and equity for my company? So any questions on mature companies? So we talked about growth companies. We've talked about mature. In terms of the life cycle, what's left? Let's talk about the most depressing part of the life cycle. Let's talk about declining companies. Part of the reason we have trouble with declining companies is psychological, and I'll explain what I mean by that. It takes a frame of mind that most of us don't feel comfortable adopting. Part of it comes with all the pain that comes with decline. But what does decline mean? When I look at your past, when I ask you, what are your cash flows from existing assets? And you show me a history. If it's a declining company, you know what I see, right? Your revenues are sliding down over time. For whatever reason, your margins are under pressure. Take a look at Bed Bath & Beyond's revenues over time. Now, you're going to see the revenues come down, margins are shrinking. When I ask you the value of growth, you look at me like I have 2 heads. You say, what value of growth? That was 10 years ago, 20 years ago. Now you're talking about shrinking. So what you're thinking about, your objective is not to reinvest more and grow, but actually shrink your company and take assets out, shut down stores if you're Bed Bath & Beyond. When you think about why risk might change, as you change as a company and you shrink, it depends on what parts of the company you're shutting down and selling off and what you do with the cash. See why that matters? If you're Bed Bath & Beyond, you shut down stores, you take the cash and use it to buy back stock. You're almost asking to go bankrupt, right? Because the debt is still there. If you take that cash and pay down debt, maybe you could become a safer and smaller company. And finally, when I ask you, when will the good times begin? Your answer is there are no good times. At this point, you have to stop. And here you might consider the possibility that assuming that your company will grow at a constant rate forever might not be the right assumption because it doesn't deliver the higher value. So what do you do instead? At the end of year 5 or 10, you take liquidation value, you take what you can get out. I mean, admit it, with Bed Bath & Beyond, that might be your optimistic view of the company. Because I don't see an end game where people keep coming into Bed Bath & Beyond stores for the rest of eternity. They're not coming now. Why would they come for the rest of eternity? Okay. So let's start with the psychological part. You're all valuing companies. Don't act surprised. You are valuing companies, whether you know it or not, and you're supposed to turn it in. How many of you are using a negative revenue growth rate or estimating a negative revenue growth rate for your company? You are? What company are you doing? Pfizer. And that's good then, because in a sense, this is a question I ask for almost every DCF audience I have. People who do valuation every day, they've done it for 40 years. You know how many people have been valuing companies for decades and have never used a negative revenue growth rate? And that should strike you as strange, because do some companies shrink? Yeah, how come you never run into these companies? Or maybe you do, And psychologically, you're unable to put a minus number in there. It just makes you feel unwashed. No, I can't do that. It's not natural. That's the psychological part. Putting in a negative revenue growth rate, making margins smaller seems almost, we're not wired for that. As human beings, we're wired to be optimistic. So that's the first thing, getting over that psychological limit of saying, okay, I can put in a negative revenue growth rate. It's okay. You're valuing a tobacco company. You know what? Negative revenue growth rate might be the best estimate to put for the company. It doesn't make it a bad company or a bad investment. It just means your core business is shrinking. Fossil fuel companies, especially if you believe that climate change is going to bring significant change to business, you value ExxonMobil, a minus 3% growth rate might not be a bad assumption. So I'm going to show you what happens. But the worst case scenario here is you have a company in decline and you value it. The realistic thing the right thing for this company to do is actually shrink revenues and reduce margins, but you have management in denial. You know what I mean by that? Often when you have a declining company, what do? They hire a new CEO and they tell the CEO, make us great again. This is asking for disaster. Because you know what this is? This is like being in a casino and you're going to put everything on number 23. And if it pays off, you're the superstar CEO for the rest of eternity. If it doesn't, you say, it wasn't my fault. Marissa Mayer spent $5 billion trying to make people use Yahoo again. $5 billion that went down the drain. But it's not her fault. She was given this mission, rescue the company. Sometimes when you value a declining company, you got to look at who's on top of the company. And if it's a person with a lot of ambition, you don't want a visionary running a declining company. Trust me. I mean, that's a recipe for, you don't want Steve Jobs running Bed Bath & Beyond. You're going to drive the company into the drain and invest billions of dollars trying to do something you cannot do. So when you look at declining companies, you got to factor in who's running the company. So I'm going to take you back in time. The valuation I did of JCPenney. And this was right after they'd hired somebody from Apple to run JCPenney. You can see how people seek out success, right? Marissa Mayer, where did she come from? Where did Yahoo find? She was, I think, the number 7 employee at Google. So she'd actually grown and succeeded at Google. So you pick these companies which have great growth and you say, maybe I can live in reflected glory. So JCPenney had hired the guy in charge of Apple stores, and Apple stores had succeeded, come into JCPenney and make us shiny and valuable again. I took one look and said, have you ever been to a JCPenney store? How do you make this shiny and valuable, right? You can make it less unattractive and perhaps somebody might even come in. So when I valued the company, I was I thought I was this was my optimistic valuation of the company. I put in a minus 3% growth rate for the next 6 years. What am I effectively doing? I'm assuming that JCPenney is shutting down its most expensive stores. So if JCPenney has a store in New York City, my advice is get out of there. You don't want that expensive lease. And going back to a core business, and I'm making the assumption that there is a core JCPenney business that will still survive. Maybe I'm wrong on that. But maybe if they go into suburban and rural areas and cater to an older population, maybe half the stores they can survive. That's basically what I'm doing. I'm shrinking the company, making it smaller. And while it's shrinking, see this reinvestment number? It's negative. You're saying, what does that mean? You're shutting stores down, you're getting out of leases, and the lessors are actually paying you to leave. So rather than putting money into the business, you're taking money out of the business. You invested capital shrinks, the company shrinks. You're basically making your company smaller. The optimistic side here is when you get to year 10, I'm assuming they've hit some steady state, a smaller company that can now grow with the economy or with inflation. That's giving me my terminal value. And the value per share that I got with that assumption put in was about $4.8 billion. But I had to be realistic. This is a declining company. It has a lot of debt and leases, and things could go bad. A recession could push them over. So I attached a 20% chance of failure based on what their actual rating was as a company. This is the advantage of working with declining companies, is unlike startups where you don't have an external measure of default risk, here you have Moody's and S&P rating the company. That 20% of the time, you know what I assume my equity would be worth? Nothing. How much am I going to get back? Liquidating all my other stores, all the inventory, 50% off, 80% off. Maybe I'm being unrealistic, but basically, you look at the value that I'm getting, it's half of what my fair value is. The value that I get for the operating assets is a weighted average of what I get for the company with success, a going concern, and a 20% chance of failure. I'm opening the door to how to deal with distress rather than try to bring it into the discount rate. You're going to estimate a failure probability and attach how much the equity will be worth with that failure and take an expected value. So let me use a slightly more elaborate example of how to estimate that failure rate at distressed companies. Does everybody accept the proposition though, that if you do a traditional DCF and you do it right for a distressed company, you're going to value it as a going concern, but that's going to be too high a number given the chance your company will not make. So your key issue then becomes, how do I estimate the likelihood that my company will fail? And I'll give you 3 ways of doing it. And then how do I incorporate what will happen to my equity in case that happens? So one is what I did with JCPenney, estimate the probability of failure, is to look at the bond rating and trust the ratings agencies. And basically the way you trust the ratings agencies, you go back in history and say, if I have a BB rating, what is the likelihood that the company will fail given the history of BB rated bonds? 18.3% gives you false precision because you're getting that second decimal point, but you're using the history of defaulted bonds. But if you have traded bonds, I'm going to give you another way in which you can estimate probability of default that you might or might not like. But it's actually a fun way to think about how you can use the bond market to estimate a chance that your company will not make it. Because let's face it, stock investors in equity markets are easy to distract. You hold up shiny objects, oh my God, look at the growth. Bond investors, you got to give them credit, are single-minded. What's the only thing they care about? Will I get paid? Will I get paid? Will I get paid? You show them growth, I don't care, will I get paid? And that gives them, I think, an advantage when it comes to things like distress, because they're going to look at, will my interest payments get made? So I'm going to use the bond price to back it out. And if you have neither a rating nor a bond price, I'm going to suggest a statistical technique that you might be able to use to estimate a probability of default. So here's the company I'm going to use as my example. It's a company called Las Vegas Sands. Heard of it? Las Vegas Sands is a casino company. And casino companies have this strange phenomenon. They tend to be run by megalomaniac narcissists. I mean, this might be a generalization, but they're all run by Caesars. So you had, if you look at Wynn, Wynn casinos run by, who ran Las Vegas Sands until about 3 years ago when he passed away? A guy called Sheldon Adelson. Sheldon Adelson, he owned 52% of Las Vegas Sands. He had control. And the 2 things that megalomaniacs care a great deal about are control and making money. Control comes first, making money often is secondary. There's a reason I'm bringing that into the story. Las Vegas Sands was one of the fastest growing casino companies between 2000 and 2007. They built casinos in Vegas, casinos in Macau. In Singapore, there is this, this gigantic hotel that's shaped like a ship. So it's all over the world. And if you've ever driven by a Vegas casino, it's a huge infrastructure investment. And I remember getting lost in the Bellagio. And I had to go to do a presentation. This to show you how big the Bellagio is. It has 28 restaurants in the hotel. God help you if you start walking in the wrong direction, because it'd be 2 miles back to where you want to be. So these are hundreds of millions of dollars, each one. Now, there are 2 ways you can raise money to fund these big infrastructure investments, right? You can borrow money or you can issue shares. Guess which one Las Vegas Sands chose to employ? And it's not uncommon. Casino companies do this all the time. Almost entirely debt. Why? Because when you own 52% of the shares, you're terrified that if you issue shares to build these casinos, you'd lose control. So they borrowed money, they built a casino, borrowed more money, built another casino. But they were successful. And when times were good, there was actually one of the most highly recommended casino stocks on Wall Street. It's 2007. Then 2008 hits, the bottom falls out on 2 dimensions. One is The economy goes into recession. Fewer people are coming to casinos. Your revenues and earnings are suffering. The second is all that debt you'd accumulated that people did not notice before. People start to notice now. So this was a valuation I did of Las Vegas Sands in February 2009, when rumors were circulating, and they were very wide, that Las Vegas Sands would not make it through the next 6 months. Will they make their interest payments? So those rumors are swirling around. I put them to the side and I sat down and I did what I did a textbook version of how you fix a troubled company. Maybe it's my own textbook, but still a textbook version. What do you do to fix a troubled company? You bring the revenues back, you improve the margins, you lower the debt ratio, all in a spreadsheet. I fix the company, I made it a nice, healthy company, I give it a big terminal value, I come up with a value per share of $8.12. So this is built on the presumption that my margins improve over time as the economy comes back, that my debt ratio goes down over time as the company becomes healthier. I've essentially fixed the company in my spreadsheet, made into a going concern, given it terminal value, and valued the share at $8.12. The stock was trading at $4.25. Ask me the question. What's the question you ask when you to see if anybody did I buy? And I said, no, I'm not interested. Which led to some soul searching, right? Because the value is 812 according to my intrinsic value. You know what was holding me back, right? All those rumors about how this $8.12 is the value of the company if it makes it as a going concern. What am I concerned about? That might not be the case. So I wanted to estimate the likelihood of failure, and I'll show you how I use the bond price. Las Vegas Sands had bonds outstanding. It had a 7-year bond outstanding with, it was rated B+, so I could have used the rating to come up with the probability, but I wanted to see if I could use the bond market to get a more finesse number. 7-year bond with a coupon rate of 6.375%. It was trading at $529. Remember, bonds are face value of 1,000. So if you're trading at $529, you're trading at a huge discount on face value. Now, normally, the way you price a bond is you take the coupons and you discount them back at this default risk-adjusted discount rate, you come up with the present value. I set it up slightly differently. I took the price of the bond. I took the promised coupons. Remember, these are promised coupons based on the bond features. And then I said, look, those coupons will get delivered only if the company is around to pay them. So I multiplied each one by 1 minus the probability that the company would fail. Of course, right now, I don't know what that number is. And because I've adjusted the coupons for the likelihood that I will get paid, guess what I discount those coupons back at? I discount those expected coupons back at the risk-free rate. So basically, instead of taking the promised coupons and discounting them back at a risk-adjusted rate, I'm making the promised coupons into expected coupons. Trust me, it's going somewhere. So I have the price of the bond, I have the coupon and the face value, I have the risk-free rate. What's the only number I don't have? The probability of distress. I used the solver function in Excel to tell me what that number is, and it came back with 13.54%. You're saying, what is that telling me? That the chance of failure is 13.5% a year based on the pricing of the bond. It's each year. I need to survive 10 years to get to nirvana, to get to the terminal value. So if there's a 13.5% chance of failure each year, guess what the likelihood is that it'll make it to year 10? It's about 23%. There's a 23% chance that my company will be a going concern. It's worth $8.12. The remaining 77% of the time, tell me what's going to happen. It's going to falter on its bonds, fail to pay, and then it's got to sell the casinos to whom? Other casino companies are equally in trouble. They don't have the money to do it. You're not going to get face value. And then you're going to pay off all the debt. There's zero chance my equity is ever coming back to me if that happens. So my equity is going to be worth zero. So I have two values, $8.12 for Las Vegas Sands as a going concern, zero as my value if it doesn't, 77% chance of that. My expected value is $1.92. And that's, I think, the best way to think about distress is you got to really worry about that probability of failure. What are the things that could move it? Remember, anytime a company goes into distress, there are restructuring talks. You're watching those like a hawk because the outcome from those talks can very quickly alter those probabilities. A little later in this class, we're going to talk about buying equity in deeply distressed companies as options and why you might do it. Here, you're still treating it as a going concern and say, what's that equity worth? Any questions on distressed companies? Yes. There's a risk of failure. So the first part of what you said, the risk of failure is what? Okay, so you're saying I computed a compounded annual average, and you're saying instead of 13.5% every year, why not have 40% in year one? So usually failure risk is greatest in the near term and drops off. It will, if you wanted to, you could actually bring it in, because ultimately the big cash flow is the terminal value, right? So playing with the intermediate years is not going to alter value that much. So that's why I just took the compounded average. If you have big cash flows that are due in the near term, and that's what you're building on, then you might build in a term structure for failure rates. You can actually do it, because all I need to do is find a 1-year bond, a 2-year bond, a 3-year bond, and do exactly what I did with the 7-year bond. And I'll get probability of failure in year 1, in year 2, in year 3, and attach that to each year's cash flow. And that'll give me a more refined value if I wanted to, because I am doing a bludgeon approach here. We're taking expected value, failure rate today, what's my equity worth? But you could actually carry it out over time. Yes. And it is, but when you do the market value of debt using the default risk, what are we effectively doing? We're taking the promised interest payments, we're acting like we make the payment, right? So if you look at how we get that cost of debt, implicit in the cost of debt is if I'm going to make the promised payments, there's much more risk. So even though we're using a higher cost of debt for riskier companies, we're still acting like we make the entire interest payment back. So the presumption is I'm still going to survive. I'm going to have a lot more angst about doing it, but I'm going to pull it off. And that's, I think, part of the problem. Discounted cash flow valuation, as it was designed for companies. The chance of failure was so low you could ignore it. In 1970s, 1980s, that might have been true with the kinds of companies being valued. But if you're starting to value distressed companies and companies with chance of failure is high, I would do it only for companies which were below investment grade. I don't want to do this with BBB, single A, because the chance of failure is small enough that I can bring it in somewhere. But as the failure risk gets higher and higher, you almost have to separate it from the valuation. Otherwise, it'll throw everything off. Let's talk about valuing emerging market companies. Again, let's go through the questions. What are your cash flows from existing assets? What do? You look at the financial statements of the emerging market company. Now, I know people complain about the quality of accounting, but I remember how divergent accounting standards used to be 40 years ago. You live in a world where there's far more convergence than divergence. Even countries that don't have IFRS are moving towards IFRS. It's true that there can be fraud and there can be things held back, but that's going to be an issue. When I say, what are your cash flows of existing assets? You look at the financial statements, you might have less faith in the cash flows you get for a Chinese company and saying, I don't know how they're pretty opaque, they have cross holdings. And ask you what's the value of growth, the same opacity will get in the way. If they have holding structures, you can't see where they're investing and what they're investing, it becomes more difficult. Every question, in a sense, using the same techniques, but you're working with data that you feel less secure about. And to top it all off, of course, you have these holding company structures. Again, not unique to just emerging markets, but in many emerging markets, it's more the rule than the exception. Family group companies, and there are cross holdings you got to deal with, and intra-company transactions. You're much more at the mercy of the people running the company because they can move wealth around. So let's talk a little bit about country risk first, which we've done before, and then talk about corporate governance. First, when you think about country risk, I want you to remember what we did with country risk. We came up with country risk premiums, but rather than use it as a bludgeon to beat up every company in an emerging market, we asked the question, where does this company get its revenue? The implication is you can have an emerging market company like Infosys or Tata Consulting Services or Embraer, which is in an emerging market, but gets a bulk of its revenues in developed markets. Or you can have a developed market company like Coca-Cola, which gets a big chunk of its revenues from emerging markets. So rather than think about the country of incorporation, I said, think about where you get your revenues, and country risk has to reflect. I mean, I gave you two ways of dealing with country risk, which is one is to do the weighted average of the equity risk premium to the different countries you're in. Or the exceptional case, we have a single country and that's all you're focused on. This was the Embraer valuation in 2004. I said, pick the country you're most worried about and estimate a lambda basically capturing how risky your company is on that country risk dimension. So that's the lesson I would like to take out of country. Second, people freak out about currencies. In fact, one of the things I get asked frequently, should I push up the discount rate because there's currency risk? The answer is, for the most part, no, and here's why. Currency risk is real, right? But there are two dimensions. One is when people talk about currency risk, they're talking about first devaluation in currencies. And you got to separate out expected from unexpected. When you think about how we adjusted for inflation, you have a country with a 9% inflation rate, another country with a 2% inflation rate. Let's say Brazil is 9%, the US is 2%. When you do expected exchange rates, real to dollars, what do we do with discounted cash flow valuation? We don't use today's exchange rate. We take that and we depreciate it about 7% a year, the difference in inflation rates. So we bring devaluation to the cash flow. So if that's what you mean by currency risk, that your currency can devalue, we've already built it in. If what you mean by currency risk is the devaluation can be greater or lesser than expected, I'm not sure I should be bringing that into discount rates because I have investors who are in 50 different countries. And when they look at their portfolios, that risk, for the most part, should be diversifiable risk. A BlackRock or a State Street or a Vanguard, which as an international fund shouldn't even be thinking about currency risk at the broad perspective, because when the dollar strengthens, some of the companies are going to benefit, some are going to be hurt. So for the most part, be ready for that pushback, because often people want to push up the discount rate of a company in a country where currencies are volatile. The country risk takes care of the risk premium. The currency risk just basically flows through. So just to show you that currency shouldn't matter. Take a company. This is 2017 and 2018 as valuing the company. It's a company called Infosys, Indian company, outsourcing company, gets 90% plus of its revenues outside India. I did a valuation of Infosys in rupees. So there's my risk-free rate, risk premium, came up with a value of 614 rupees per share. A minute later, I decided to revalue the entire company in US dollars. Now, what changes? First thing is my risk-free rate from 5 to 2%. So let's start with the good news. When I use US dollars, I have a lower cost of capital for Infosys than I do in rupees. Why? Not because of country risk. That's in both discount rates, but because I've moved from a high inflation currency to a low inflation currency. Lower discount rate is good, right? And a discounted cash flow valuation. But I'm not done. See these growth rates? Growth rates have a currency embedded in them as well. That 12% and 5% growth rate you see in rupees reflect an Indian rupee inflation rate. When I did the same growth rates in US dollars, that inflation effect comes out. I have a lower growth rate in US dollars than Indian rupees. So I have a lower discount rate because of inflation, a lower growth rate because of inflation. You can see what's coming. When I do my net present value, or the present value of the cash flows, the value that I got was $12.79 per share, which converted at the prevailing exchange rate that day would have given me 614 rupees per share. Incredibly good news. I don't know if any of you are valuing a Russian company, you're valuing a company in Turkey, and you're saying, I'm getting tired of carrying a 25% inflation rate through time. This basically says, go pick a different currency, do everything in that currency, and as long as you're consistent, the value per share you get should be the same in every currency. So it gives you an out when you're dealing with a currency with extremely high inflation. Because high inflation currencies are a pain to work with in valuation. We know what to do, but that doesn't mean it gets comfortable. Finally, corporate governance drag. And again, I don't want to make it sound like emerging market companies are bad corporate governance and developed market companies are good corporate governance, because that's not true. Corporate governance can be good or bad in every part of the world. But it's true that because of the history of how companies developed in many of these emerging markets, there's a bigger issue with corporate governance. And people they worry about it. Should I have a higher discount rate because I have bad corporate governance? What do I do? Should I discount the value? And I think we kind of came up with the answer. If you're doing the valuation, you control how you estimate cash flows and discount rates. You have a mechanism you can use to bring in the effect of bad corporate governance. So I'm going to use an example. This is a company called Tube Investments. It's a South Indian publicly traded company, and a company that I've known all my life because, it's a company where, I remember the owners of the company coming to my house when I was 6, 7, 8 years old. And of course, so I've seen the company's history. So a few years ago, when I was back in Chennai, which is where I grew up, the people, the family group running the company called me, said, can you come in and talk to our top management? Because we think our company is severely underpriced. It's trading at 101 rupees per share. It should be trading at far more. So I walked in and I said, okay, I'll do an intrinsic valuation, but I can't promise you that I'm going to confirm your biases. So here's what I found. I found a company that was reinvesting like there was no tomorrow, 112%, huge amounts of reinvestment, entering new projects, new businesses. You think this is good? In fact, the return on capital was about 9.2%. That doesn't sound bad, right? But this was in India where the risk-free rate was 12%. So they're growing and they're reinvesting, but they're growing and reinvesting in bad businesses. So I put in that growth rate. And normally when I have this with a US company with reasonable corporate governance, you know what I'm going to do is as I move towards a terminal value, I'm going to fix the problem. I'm not going to let you keep investing at 9.2% if your cost of capital is 16.2%, because somebody from the outside, your shareholders, an activist investor, is going to put pressure on you to change. Here, I did not do that. I left them on this destructive path. And I'll tell you why, because they did not see a problem. They said, we're growing. Why were you punishing? Growing is only half the game. Growing and creating value is the other half. They were growing, but they were growing badly and destroying value. But I left them doing that because there was zero chance of change in this company. What does that do? If you keep growing at, let's say in this case, I assumed a growth rate of 5% a year forever, and you keep reinvesting at 9.2% and when your cost of capital is 15, 16%, you're going to grow and you're going to get a terminal value, but the terminal value is actually lower than it would have been if you didn't reinvest at all. The value per share that I got was 62 rupees. So I said, you know what, you might complain about the 102 rupees, but market's probably being far too upbeat in my view, because you guys keep running the business the way it is, it should be worth only 64 rupees. So I offered them a chance of what would you do to increase value? You know what the first reaction was? We should reinvest more. First rule when you're in a hole is stop digging. Reinvesting more is only good. In fact, because I had the spreadsheet, I said, let's try it. What do you think? 150% reinvestment rate. They made that 150%. Now, I actually used a 60%. They said, why don't you make it 112% like it was last year? The value per share went to 45. And after about the second or third try of increasing the reinvestment rate, they realized it wasn't happening. If you want to increase value here, that's the first thing you need to fix. You either need to increase the return on capital on new investments. You see, what if I can't do that? Just stop. You make this reinvestment rate 0 in this example. You know what's going to happen to value per share? Probably going to go to 125 rupees per share. Sometimes doing nothing is better than doing something. In fact, a lot of times you could argue doing nothing is better than doing something. But this fixation on growth, I think gets in the way of that, because you've been told that, in fact, you could argue that if they can get out of business, they should try to go for a negative growth rate, sell off businesses, take their cash out and do something good with it. So you can play with the numbers there. In fact, after they did that, I took them through 2 phases. I said, look, let's move the return on capital from 9.2 to 12.2%. It's unrealistic to expect to go to 16.2%. That brings your value to about 100 rupees per share. If you can move the return all the way to 16%, it goes up to 150 rupees per share. Have less focus on growing and more focus on the quality of that growth, because that's really what's driving value. And with many mature companies with bad corporate governance, that's what you worry about. They get into a hole, they can't stop digging, and that's going to mean less value for you. And of course, cross-holding. We talked about how difficult and messy cross-holdings are. In fact, as a warning on your next quiz, this is the one part I want you to go through the past problems and recognize when you add back, when you it's a nightmare, right? Sometimes you add, sometimes you subtract, but getting comfortable with it. And with emerging market companies, and again, not just with them, you have this issue in spades because many of these companies have histories as family groups. They're connected to each other in ways. And whether you like it or not, a chunk of the value comes from their cross holdings. So again, staying with an Indian example, I had to value 4 Tata companies for the Tata Group, one of India's oldest family groups. And I value the companies. I did an intrinsic valuation. That's what you see in the blue part of the asset. That's my discounted cash flow value, free cash flow of the firm discounted back at the cost of capital. But then I had to adjust for cash and cross holdings. See the red part? That's a cross holding component. If you take Tata Chemicals, half of its value comes from its cross holdings. And what do I know about them? Very little. Like the one company that has very little cross holdings is Tata Consulting Services. You know why? The youngest of the companies. So these cross holdings are not a conspiracy to make your life difficult. They're a reflection of these companies' history. 50 years ago, Tata Motors needed to build a factory and Tata Steel had excess cash. You know what the family did. They owned both companies. They moved. They weren't doing this because it was an internal capital market. But the accounting for it basically meant that Tata Steel now owned a piece of Tata Motors. And the older you are as a company, the more you're going to accumulate these cross holdings. But this red part is what makes me incredibly uncomfortable because I'm not sure what the value is. The blue part, I can say, did I get the cash flows right? Did I get the risk right? But that red part is going to always be messy to deal with. Finally, truncation risk. We talked about truncation risk from distress, right? But truncation risk can take lots of different forms. I remember valuing an Egyptian hotel company. It was about 10 years ago. I don't even know why I was valuing it. But this was actually a hotel that then got targeted in a terrorist attack and essentially demolished. You say, why did they buy insurance? You know how much insurance costs? I mean, it's not always practical to insurance against some risk. So when we talk about terrorism risks, I mean, that can affect the value of a company, especially in countries that are completely exposed to it. It could be natural disasters. You invest in a company in the Caribbean, it's again a tourism-based company. One big hurricane goes through, there goes your entire business model. And finally, of course, if you're in a part of the world where the government gets pissed off at you, they just take you over. These are all truncation risks. And what should you do with them? Exactly what you do with failure risk. Assess the likelihood of it happening and then ask, what will I get if it happens? I know several of the students from this class have gone back to Venezuela. They run businesses, and often I get calls from them, successful businesses. I'm doing really well. So that's good. I'm glad for you. And say, I'm scared. And usually when you're doing well, you're not scared. And so what are you scared of? I'm doing so well that the government has started noticing me. And I said, that's not good. And of course, what they're talking about, how do I bring in nationalization risk into my valuation? The answer has to be, you got to, whether you like it or not, assess the likelihood that will happen. And then assess, what will the government pay me? It's not going to be fair value. It might not even be book value. It might be nothing in some cases if that happens, and take an expected value. So I'm going to give an example of how truncation risk plays out in valuation using Aramco. And this is, of course, one of the valuations of the week that you had. In case you did see that valuation of the week, you forgive the repetition. But when I valued Aramco initially, I valued it as an oil business. In fact, it's one of the few valuations where I used a finite life to value the company. Why? Because it's really not a company. 300 million barrels of oil in the sand. And once the oil is out, there's nothing left. So I put in a 50-year life, came up with the present value of the cash flows. I used a dividend discount model, free cash. It doesn't really matter. Whatever value you attach, you come up with the value of about $1.6 to $1.7 trillion. It was by any means the most valuable IPO of all time, because overnight, the day it went public, it became the largest publicly traded company in terms of market cap, because it actually had a market cap greater than Apple at that time. So I did a traditional valuation, and I finished the valuation. I come up with the value 1.6 to $1.7 billion. But it's a traditional valuation, right? You take expected cash flows, you discount back at a risk-adjusted discount rate. But when you buy Aramco, you're not buying a typical company. In fact, I don't even know whether you're buying a company, you're buying a country, right? It's Saudi Arabia Inc. It's 80% of Saudi Arabia's GDP comes from Aramco. You're buying a country. And it's not just a country, you're buying a ruling family. You're buying into the House of Saud, you're buying Saudi Arabia. You see where I'm going. This is a clear case where country risk is real and present. It's in none of the numbers. Because how do I get the country risk from Saudi Arabia? I look at the rating for the country, and that doesn't reflect any of these worries. So here's what I did, and I have to tell you, I'm not good at political forecasting. I said, what is the chance of a regime change over the next 50 years? I think I'm being pretty upbeat by assuming it's only 20%. I mean, look at how quickly Egypt turned from, from a dictatorship to to complete change. You could have, the same thing happen in Saudi Arabia. It's 20%. So what would happen if there's a regime change? Depends on who's the new regime is. If it's ISIS, who knows what Saudi or what Aramco could become. But in most cases, you're not going to kill the goose that lays the golden eggs. It'll just mean that they'll charge a higher royalty tax. Effectively, it means you will not get what you thought you were going to get before the regime change. Attach a value of half of the existing value, and attached probability is 80% times that the value of equity that I've estimated, 20% times half that value, assuming that royalties change. My expected value then reflects the likelihood that the regime will change and how it will affect my value per share. So if you're dealing with truncation risk, in some of your companies you are, the best way to do it is to actually separate it from and do two separate valuations. You'll be telling two stories then for your company. One with one regime, one with the other, one with one regulatory rule, the other with the, and take the expected value across the two. And I think that's a more realistic way of dealing with this kind of risk. You at least get started on valuing banks. I think I told you that pre-2008, I used to start my banking chapter with a statement that I've never been able to live down. Valuing banks is easy. Because pre-2008, the way people valued banks was with the dividend discount model. We'll talk about why that is, but it was the last bastion for the dividend discount model. But 2008, in a sense, changed the game because it showed us that banks were not always run by sensible people. So trusting them to pay the right amount of dividends might be dangerous. And second, the assumption that banks could not get incredibly risky because the regulators would prevent that from happening kind of blew up as well. So pre-2008, the reason we did that was asking and answering the question in valuation were really difficult. If I ask you, what are the cash flows you have from existing assets at the bank? How do we get cash flows? We start with earnings, we add depreciation, we subtract capex and subtract change. Try doing that for a bank. You're very quickly going to go up. Banks are opaque. We make a Faustian bargain when we invest in banks. The bargain is that we don't know much about a bank when we invest in it. But we're okay with it because somebody else is watching the risk. That's a regulatory. That's the bargain that and it held for a long time from the end of the Great Depression through 2008. Banks were where people went for secure dividends, and they really trusted that the system held. So when you think about valuing banks, the reason they're difficult is because people would give up and they say, let me use the dividend discount model. And dividend discount models are the easiest valuation models because rather than forecast our capex and depreciation, all you have to do is forecast net income, forecast dividends as a percentage of net income. There's a payout ratio. And of course, you have to be internally consistent still. What does that mean? As your growth rate decreases, your payout ratio should go up. So you're again staying with the same principles, but using the payout ratio as your metric. So the valuation of an Egyptian bank called CIB, done entirely in Egyptian pounds. And of course, the key number which I had trouble with the most was getting a risk-free rate in Egyptian pounds. I don't know whether you remember, the way I got this risk-free rate was I started with the USD bond rate and adjusted for differential inflation because there was no government bond out there, but a high risk-free rate. In fact, the cost of equity for the bank was 23%. That's the bad news. Here's the good news. The bank earned a return on equity of 42%. It's a bank that has a solid business in a high inflation economy. It passes the inflation through, earns a return on equity of 42%, was reinvesting about 75% back. So even though this looks terrible in terms of discount rate, this bank has a growth rate that a US bank or a European bank couldn't even dream of having, a 32% growth rate in it. So it's a high growth bank with a low payout ratio in a currency where the risk-free rate is really high. So the discount rate reflects it. My growth rate over time, I follow the same principles I do with any company, decreases down to a stable growth rate of 10% a year forever. If I said I'm going to use a growth rate in perpetuity of 10% a year forever, if this were US dollars, you'd call me crazy. That can't be. It's an impossible valuation. But when your inflation rate is 10 or 11%, you can live with the 10% growth rate forever. It's less than the risk-free rate. That's a nice thing about using the risk-free rate as you can. So the 10% growth rate forever gives the terminal value, discounted all back. The value per share you get is the present value. So basically all I do is project out earnings per share, project out a payout ratio. The reason the payout ratio changes over time is my growth is decreasing. You discount the dividends per share at the cost of equity. The value per share I get is about 42 Egyptian pounds per share. The stock was actually trading at 36. I tried to actually buy the shares. Now how difficult it is to buy shares in the Egyptian stock exchange. After about the third day, I said, I'm not even trying anymore. But this is a high inflation economy, and dividend discount models are, because of their ease, you can use them around the world. But implicitly, you are trusting the bank to pay out what it can afford to pay out. So next session, after the quiz, and I want to remind you, first 30 minutes of the quiz, we're going to talk about how to value banks when you don't trust the managers of the bank to pay out what they can afford. And I'll be quite honest, there isn't a single bank in the world where I trust the managers to pay out what they can afford to anymore. So I'll talk about the alternatives to dividends, how you get a free cash flow to equity for a bank. But I think that it might be something that if you're valuing a bank, you might want to try out, not for tomorrow's valuation, but after I give you the feedback on that, if you use the dividend discount model, you might want to try the alternative, which is to estimate what the free cash flow to equity for a bank is and to value it on that basis. I will see you on Monday.
So I have one day. And I was reading the